Our 10th speaker, here's Yusra, who's going to be talking about stocks.
Good morning, everybody. Good morning, everybody. My name is Yusra, and it's a pleasure to be here with you today. It was early last summer when I first had the pleasure of making the acquaintance of Sir Andrew and Rachel at Zero. That was an interesting conversation I had over dinner that fateful evening. It's pretty difficult to break the news. Hey, Mom, I think I might be in debt at 17, and I may have just joined a pyramid scheme. Now, I was already getting heart palpitations the minute I started seeing a negative sign next to my balance, trust me. But if I was ever going to become a doctor at this rate, something needed to change. Prior to actually researching the stock market, I had been investing through a technique I call highly selective investment, but my father calls utter nonsense. The real world is, by all means, a fairly formal setting, but you still get access to unstructured conversations with mentors and supposed millionaires. And somebody always comes up with a new master plan for all of us to get rich quick. Now, if you know anything about cognitive biases today, you may have heard of the bandwagon effect. In day trading, which is when stocks are bought and then subsequently sold the same day, this is when someone starts buying stock because they believe that it's going to rise. And when a lot of other people pick up on the trend, the value actually does end up ultimately rising due to demand. The problem is, it decreases equally as exponentially when people individually all decide at the same time that they want to sell. Now, it had dawned on me by now that I wasn't even an adult yet and was already starting life off with a negative balance. So I decided it was probably wise to do a more in-depth analysis of the annual reports rather than blindly following Yahoo Finance and lusting after blue chip stocks. Now you see, prior to this, I had stock charts up there with seismographs and electrocardiographs and all the other squiggly lines that I could not ever decipher, and decided humanity would just be better off if we left those to the people who actually could. But I was also suffering from another cognitive dilemma at this point, loss aversion. Essentially meaning that any further losses were going to cause me far more pain than any gain was. So I was still holding on to stocks and losing positions in hopes of breaking even, when really I should have let go and just reallocated capital. I've been thinking, I mean, the lines go down, they're bound to go back up at some point, right? It only became real in my mind when I decided to go through the transaction and actually sell. But it would be a while before I stumbled across Berkshire Hathaway's letters to their shareholders and heard Mr. Warren Buffett's philosophy. He says, and I'll quote, "It has struck me that all misfortunes spring from the single cause that they are unable to sit quietly in one room." I decided to heed his advice and reflect, and realize how reliant humans are upon heuristics, or the mental shortcuts that we make in our brain. And so it's today that I would like to share with you some of the most common cognitive biases that impair thinking and decision-making when it comes to stock trading. Let's attempt to be witty here, and start off with the anchoring bias. This is when you put all your faith in one statement and allow the very first piece of information presented to you about a stock to be what you end up placing your blind faith into. It's our tendency to kind of assign a lot of weight to a single piece of information. Normally, this is the first that we've ever heard. Now, for you to kind of understand just how potent this phenomenon is on our decision-making skills, even yours, let's look at a real-life example. Bernstein and Kahneman, back in 1974, conducted a study on the anchoring bias. They divided participants into one of two groups. And I hope you're good at mental math, because I'm going to need you to make a quick calculation here. Multiply the numbers from 8 to 1 through your mind, or from 1 to 8. They asked each group the exact same question. The sole difference being the number they started off with. Hint, that's your anchor. The results are astonishing, not even close. They found that for the group with a descending condition, which means that they had a higher anchor of 8, participants predicted a value 4 times larger than the ascending group, the lower anchor. The median value for the group who read the equation starts with an 8 was 2250, whereas the value for the group with the lower anchor was just 512. The actual value though, 40,320.
That's what I got.
Now none of us returns power here, maybe you, but it's evidence that presenting participants with a higher initial value leads to a higher prediction of outcome. Essentially, the same thing happens with stocks, but it's a bit more complicated. So how it works is that the first time you encounter a new stock, if it's valued at around $5, and the next time you see it, it's now worth $15, you subconsciously got gears turning in your mind, informing you that this might actually be a good deal. I mean, what you're witnessing is, what, an exponential increase? We found that humans have a tendency to predict similar positive outcomes in the long run, rather than underestimating market values, which would be more feasible. And this trend isn't just common among novices. We don't suddenly just develop a sixth sense when it comes to trading after years. Best conducted a study on anchoring bias and stock return estimates with 300 Scandinavian financial market experts and 213 university students with not a lot of prior experience, and found that there was no significant correlation between expertise and the reduction of behavioral biases. Now, mind you, there was a considerable difference between the estimates given by the professionals and the fact that they deviated statistically and economically from reality. We often overlook other cognitive biases as well. Case in point, the recency effect, where investors give significant consideration to the stock's most recent performance and assume that current industry trends are just going to follow. That's also how we end up with disasters where you buy in high and are forced to sell low. Those buttons at the top of each stock website that you go to that tell you 1 month, 3 months, 6 months, they're there for a reason, and I urge you to actually click on them. Then, the peak end rule. In my recent medical internship, I learned that physicians are actually well aware of this. When a patient comes in, they tend to only remember the peak of their symptoms and the most recent symptoms. It's kind of similar to the stock market. We assign weight to 2 things and 2 things only. The highest value stock has reached in the past and its most recent value to deduce how well it's going to do. The idea here is that if it's reached such a high value in the past, it's possible to reach it once more. I call this one street delusion. Then we've got the sunk cost fallacy. Critics would say this one's active delusion, where an investor continues to relentlessly maintain a losing position rather than selling out, simply due to the sheer amount of resources that they've already dedicated towards it, rather than just allocating funds to something that might get favorable outcomes. I can see the looks on your faces. Some of you are definitely remembering past relationships or friendships, and yeah, it's like holding on to a glass for an extended period of time. The longer you hold on to it, the more painful it is when you put it down. Okay. So how absolutely inconvenient and heartbreaking is that? How do we avoid these biases? I've been pondering into this. How do I make a few $100s before my father notices that they're records on? My brother is quick to pipe up with AI. Plausible, but your latest network models are prone to these biases too, despite being trained extensively on field market data, and the most relevant too. So now, are these phenomena unavoidable? Merely a byproduct of physics chaos theory, which suggests that small modifications lead to vastly different results when time accumulates, and that we may never be able to predict these with accuracy? Perhaps, but more likely than not, the effect is just a result of nothing more than a lack of sufficient analysis. When trading stocks, there's a plethora of variables that can impact short-term and long-term market position. You've got to factor in competitors and industry trends, economic conditions and political climates, and the best investors, they have it down to a T. They're analyzing everything down to company management. Or they're just getting their subordinates to do it for them. Either way, U.S. potential investors have got to look out for these common biases that encourage decision-making skills. Avoid the confirmation bias, whereupon investors depend solely on information that confirms their existing beliefs and they ignore everything else through the ostrich bias. We've got to develop a broader view of the market, and no, this doesn't mean leniency with standards. A narrative fallacy is when an investor is attracted to an investment that has a great story behind it, banking more often on potential than on actual trends that we've seen. But with areas, this is more like common with areas such as everybody's favorite, cryptocurrency. When investors preach portfolio diversification as one of the potential solutions, This is not the message we want to get across. To all the young faces in the audience today, practice efficient risk management. Cut once, measure twice. And know that index funds are actually your best friend. Long-term steady growth is what will benefit you the most in the long run. The time for capacity.